Today is my ninth presentation on the subject of developing negotiation strategies for long-term borrowings following a 5W2H approach. This is going to be my 40th presentation considering all the YouTube presentations which I have made so far. What I have included in this presentation are what is the 5W2H approach to develop negotiating strategies for long-term borrowing, identifying and finding answers to 20 questions related to the long-term borrowing. There's one question on the why. There are 10 questions on the what aspects such as debt types, cost, interest rate, covenants, collaterals, etc. There are 4 questions related to the who aspects such as potential buying funding sources, who should negotiate, sign the agreement, who are the credit rating agencies. One question on when to get loan disbursals and installments of inflows. One question on where should the jurisdiction planned in case of disputes. One question on how to negotiate effectively, which is the most important aspect, and 2 questions on how much loan to borrow and the loan tenure, and the way forward. What is 5W2 approach? This approach is a problem solving and decision making framework approach that originated in Japan. It is a simple but effective tool that can be used to identify and address the root causes of the problems and develop and implement the solutions. This approach has been utilized in this YouTube blog where the 5W2S stands for finding answers to 20 questions, essential questions that can equip the negotiating team better before getting into the negotiation meeting. Question number 1 is why is the long-term borrowing required? Now, negotiating team has to be prepared with the answers that whether it is required for financing specific projects or expanding operations and capital expenditure requirements or supporting the ongoing operations or optimizing debt equity ratio or meeting the part of the working capital requirements or any combination of these above. Question 2 is what are the type of debts or long-term borrowing opportunities which are available? These can be term loans and these can be bonds, these can be debentures, and the term loans and sources include banks, financial institutes, related parties, business associates, overseas lending sources. The details of these are available in my book. Number 2 can be bonds. CFO to decide on the following: what are the type of bonds to be issued out of 8 types, face value of the or at a discount or premium options, interest rate, frequency, duration, maturity, amount, options, contents of the bond issuance prospectus, bond issuance routes such as primary market or secondary market. More details can be found in a blog post at my website titled Developing Negotiation Strategies for Long-Term Borrowings under blog categories or industries. Debentures. CFO needs to know and decide what type of debentures to be issued out of the 5 types, the principal amount per debenture instrument and the total amount, rate of interest, the debenture issuance route, that is direct or through the exchange, registration of the debenture if applicable, type of the charge or in case of secured. Now more details can be found in my blog post. Question 3 is what are the different kind of covenants which the negotiating team must be fully aware of and prepared. The lender can demand various kind of covenants, primarily 6 types, which are now stated here. One is the financial. This may mean including restriction on the debt equity ratios, interest coverage, debt service, and so on. Operational restrictions like limits on the capex, limits on the merger and acquisition, dividends payout, changes in the ownership and control of business operations, and so on. The negative covenants can be asset sales restrictions, changes in the business operations, debt equity changes, and so on. Financial reportings which can be on the P&L, it can be balance sheet, the cash flows, minimum net worth requirements and leverage ratios. Then there can be default covenants which include events will be considered as a default, for example non-payment of EMI, financial covenants, insolvency, etc., and grace period, notice requirements, remedies available to the borrower, and materiality. Compulsory management discussion and analysis. The lender may demand specific discussion with the management on various aspects such as sales and market share, performance, profit performance, prospect, etc., etc. Question 4 is what are the cost elements in addition to the interest costs? Now 17 cost elements have been identified, and these must be well understood and negotiated effectively with the lender. These can be loan processing fees and administration charges, credit assessment charges, prepayment penalties, late payment charges, ECS charges, default interest rates, legal documentation fees like stamp duty, collateral valuation fees, premature closure charges, interest rate change charges, loan rescheduling charges, security creation and registration charges, insurance premium cost, guarantee charges, consultant fees which are in any case applicable, interest swaps cost like fixed rate to interest rate to variable interest rates and vice versa, and hedging related costs in case of foreign currency which is not in this being shared in this presentation. Now question number 5 is the collaterals. The lender, financial institute or the banks may demand the 7 type of collaterals, any one or more. This can be real estate assets like mortgaging of the land or building or residential or commercial. It can be plant and machinery for manufacturing or assembly or testing or utilities infrastructure, etc., or other tangible assets, or intangible assets also patents, trademarks, copyrights. Financial instruments like hypothecation of the stocks, bonds and other securities, inventories like raw materials, WIP, finished goods, cash and cash equivalent like deposits, fixed deposits, recurring deposits, term deposits, saving bank accounts where there is a control on the receivables, bank accounts, certificate deposits, etc., and guarantees personal or corporate. Now negotiating team needs to be fully aware of these and be prepared. What factors influence interest rates? The 4 factors which are most important for understanding and negotiating with the lender are the RBI related repo rates, understanding the concept of repo rates of RBI and monetary policy, past interest rate trends, historical trends and the interest rates, track of the inflation and the market forces, the demand and supply of the funds available in the market. Question number 7, what debt reduction strategies should the borrower evolve in case such a situation demands? The debt structure optimization, switch from higher interest rates and lower rates or mixing of these, higher revenue through new products or new markets, pricing, sales promotion schemes, debt refinancing options, better cash flow management which is through operation cash flow or financial activities or through investing activities, the cost reduction and the obsolete inventory disposal or obsolete asset sale. Question 8. What are the types of risks from the borrower's perspectives? Now, RBI repo rates going up and hence the interest rates increases mainly if the borrowing is against variable interest rates. Financial stability of the lender and non-timely funds dispersal by the lender. These are the type of risks which the negotiating team needs to be aware of. Market sales downturns and inadequate sales revenue, profit and cash flows. Intense competition, industry trends and dropping market share. Debt paying capacity going down, covenants unfavorable, or 4 types I discussed, different type I discussed, unethical practices for loan sanctions and disbursals like bribes, etc. What are the risk mitigation strategies from the borrower's perspective vis-a-vis the risk I shared? Obtaining guarantees from the lender, that is a loan commitment letter and non-revocation clause. Obtaining an appropriate insurance policy for protecting the interest of the borrower, that is default coverage, sum insured, triggers, etc. Meticulous and aggressive review of each of the covenant. Cautious evaluation of the lender's credentials, financial stability and reputation. Debt restructuring strategy in place in case of any eventuality. Aggressive review and fine-tuning of the periodic dispersals. What are the type of risks now from the lender's perspective? Question number 8 continued. Now, default of the EMI by the borrower, manipulated credit rating by the borrower, misrepresentation of the financial statement by the borrower, ambitious future growth projections, inadequate business growth vis-a-vis projections, unfavorable market conditions, regulatory environments, quality of the collaterals and overvaluation of administration of the funds. These are the kind of risk which the lender needs to be aware of. In fact, he or she will be aware. What are the risk mitigation strategies for the lenders from the lender's perspective? Robust due diligence in engaging financial market experts for evaluation, active monitoring of the borrower performance in terms of repayments and business performance, careful drafting of the delayed or default in EMI payments related clauses, thorough vetting of the guarantees and from the borrowers, cautious evaluation of the borrower's credentials, careful drafting of the covenants and compliance requirements while ensuring a win-win mechanism to monitor timely EMI from the borrower and the funds utilization. What are the statutory issues to comply with? Question number 9. There can be issues like Companies Act related requirement for accurate book accounting, maintenance, securitization, creation and registration, regulatory approvals related to this vis-a-vis the SEBI or the RBI, compliance related to the GST and TDS, particularly on the interest, anti-money laundering, credit ratings, sector-specific regulations. Question number 10. What can be the ethical issues on loan transactions? Now, these can be influencing third parties such as merchant bankers, credit rating agencies by the borrower, providing false or misleading presentations, concealing of the existing debts, sharing of the confidential information of offers with the lender, or offering assets as collaterals that are non-existing, offering bribes to the lending FI bank officials, negotiating interest rates, terms and conditions without the board approval, and getting into the agreement under coercion or under influence. What can be the ethical issues in loan transaction lending company from lending company perspective? Providing misleading information about hidden costs, terms and covenants which the borrower may not be aware, offering loans at exorbitant rates or unfair terms considering the status of the borrowing company, negotiating rates terms through unfair means under the influence of the lending company officials, offering bribes to borrowing companies, sharing confidential information with malicious intent in return of personal gains. Negotiations are done by the persons neither competent nor authorized to negotiate or get into contract. What documents should be kept ready? This the negotiating team should be aware of. Details about the plants, products, services, capacities, manpower, key vendors and business associates, sales, product range, market analysis, market share, distribution channels, competition analysis, capex incurred, financial statements, income, balance sheet and profitability projections, available cash and cash flows, collateral availability and values, credit score ratings, retained earnings, existing debt obligations and debt services. Continuing, business plans, cash and cash flow projections, potential contingencies, liquidity projections, tax estimates, statutory requirements, risk assessment and covenants. Question number 12. Who are the potential sources for the long-term funding? Now, these can be financial institutes, NBFCs, banks, private placements, venture capital, private equity. Details of these are available in the articles getting published at my website. Who should participate in the loan negotiations and who should sign the loan agreement? Question 13 is who should participate? Suggestion is that it should be CFO plus the legal head at least. An independent financial advisor can join. Then there can be some loan negotiation experts. Question number 14. Who should sign the loan agreement? Preferably by the CFO plus the legal head jointly post board approval. Who are the reputed credit agencies? Question number 15. In India, these are CRISIL, ICRA and CARE, and in the international front, these are Standard & Poor's, Moody's, Investors, Fitch. Details of the rating system for each one of these are given in my book. When to get loan disbursals and installments for inflows? This is a very important question. Advanced requirement, there can be different stages of the inflows. One is the advanced requirements of the vendors and service providers and the consultants, particularly in terms of large amounts. Number 2 is at the time of shipping of the significant equipment by the vendors, at the time of installation, testing and commissioning of such equipment, and at the time of prototyping, production and sales launch of the product or services offered by the borrower. Where should be the place of legal jurisdiction and which law should be applicable? The place of jurisdiction should be preferably the city and state of the registered office of the borrower. Alternatively, it could be where business operations are performed, where the equipment facilities procured out of the borrower funds are utilized. For any deviation, the legal team should be consulted. In any case, the laws of India must be applicable. Negotiations, of course, can be held at any place which is mutually convenient, either at borrower end, lower end, lender end, or anywhere else. How to negotiate effectively? Question number 18. Now, there are different steps. There are 6-7 steps which are suggested. Number 1 is shortlisting the term loan potential sources based on the various evaluation parameters. Number 2 is obtaining competitive offers from these potential sources, which could be 3, 4, or 5. Comparison of the charts, which includes the making of the comparison charts, which includes rates and terms and covenants and collaterals, etc. And then negotiating team preparing 2 templates, template 1, template 2. Template 1 is an Excel sheet with which there can be 23 cost evaluation parameters among different lenders. Now these can be besides the interest costs, many other cost elements which I have shared earlier. Template 2 will include the 23 covenants, which are collateral and covenants, etc., and few other evaluation parameters amongst the shortlisted lenders. Now these templates are in a scheduled blog related to negotiation strategies for long-term borrowings at my website. Now number 5 is evaluating borrowers' preparedness to negotiate collaterals and collateral based on strength, risk, appetite, growth potential, etc. And in fact, it is a two-way round. It is both the lender and the borrower both. Negotiation strategy must, of course, be creating a win-win. Question number 19. How much long-term loan to borrow? This depends on the various factors such as business plans for the sales, products, market, local or export, and market share, the purpose of the loan, the capital expenditure plan and the potential contingencies, the projection of the income, balance sheet, profitability, available cash and cash flow projections, retained earnings and equity enhancement plans, if any, by the promoters or otherwise, existing debt obligations, liquidity projections, debt service coverage ratios, cost of the debt, statutory and tax implications, and risk assessment for the market condition, competition, and regulations. And last question is, how much should be the tenure of the borrowing? This should be based on the projected cash flows. This can be 1 to 3 years, 3 to 7 years, or 7 years. And the negotiating team must remember that they need to balance the interest rate and the ease of EMI. Way forward. Long-term borrowing sources in India offer many opportunities, each with a cost perspective, strategic considerations, and ethical issues. Choosing the right source depends on the borrower's financial needs, risk appetite, market conditions, benchmark interest rates, and ethical and statutory compliance commitments. There has to be absolute fairness in terms of financial reporting, fairness of the collateral valuation, and wording of the covenants that inspire confidence. By carefully weighing these factors, borrowers can certainly secure long-term financing that aligns with the goals of the borrowing company while upholding the legal and ethical standards. Future references. My next book on the corporate finance and accounting functions transcript has been finalized, and it's now with the publisher at the editing stage and will be launched in the next few weeks. You can also refer to the following for more details on this topic. Chapter 8, which is titled as Borrowing Long-Term and Short-Term in my book, to be launched soon. Forthcoming blog titled Developing Negotiation Strategies for Long-Term Borrowing Using 5W2H Approach. This blog will be under the category Industries. All Industries is my website, ethicalprocess.com. You can also refer to some other articles of interest to the corporate finance team and also refer to the Facebook and LinkedIn. Thank you very much.